The ones that you're really interested is this one. So income-driven payment plans are created for graduate professional students who graduate with high debt and they don't initially have the ability to pay all those, standard payment amounts. So you need some type of relief during your residency years, training years, or maybe you're just starting your career and you don't make as much money. Or your heart is, let's say, in public service. And if you choose a public service kind of job, it doesn't pay as much as what you would make in corporate America. But that's where your heart is. You want to do that. That's why you went to school. So on and so forth. So whatever reasons you may have, you are more likely to utilize, I believe, the first one, pay as you earn. Pay as you earn is the payment plan that looks at 10% of discretionary income. It only looks at adjusted gross income, and the discretionary income is basically what's left after when you pay all your necessities, what's left to you to spend, which is the discretionary income. It looks at 10% of that income when they are calculating your monthly payment and the number in the household. So if you graduate as a single person, or some of you are already married, I know you're in professional school and some of you start young. We have married students as well. So if you are single, let's say, and you graduate, and now you want to utilize pay as you earn as your payments, it will only look at your income, which could very well be zero the year before because you were a M4 or D4 or pharmacy fourth year student, or a master's second year student who is about to graduate. I don't know. If you are a student who had no income, and all the professional schools pretty much don't have income because you're constantly studying, and we don't want our professional students to work so they could succeed in their studies. But if you have zero income, most likely that's 10% of that zero income will be zero payment. But that is still an eligible payment. It's still a good standing status. Most of you will utilize pay as you earn. The revised pay as you earn is the same thing. The difference is, some of you, I doubt that it applies to this group because you are all new borrowers. Some of the students who had been borrowing for a while did not meet the definition of new borrower according to the pay as you earn. Pay as you earn has a requirement. You have to be a new borrower. Borrowing, basically, you cannot have a loan balance before October 1st, 2007, and you must have a loan disbursement, direct loan disbursement, after October 1st, 2011 is the requirement to be eligible for pay as you earn. So if any of you have a borrowing history before October 1st, 2007, which I doubted, it's 10 years ago, then you are not going to qualify for pay as you earn, but you will qualify for revised pay as you earn. This came out a couple of years ago for those borrowers who are not qualified for pay as you earn, but you can do the revised pay as you earn. They both start the same. They all look at 10% of discretionary income and the number in the household. There are a couple of differences down the road. For example, pay as you earn only looks at income. If you didn't file with your spouse, they do not look at your spousal income if you filed married filing separate. The revised pay as you earn, one of the major differences between the two, looks at the spousal income regardless of your filing status. So if your goal is, hey, I'm going to utilize one of the loan repayment options out there, I'm going to have the government pay my loans in 10 years, I'd rather pay less out of pocket. If your goal is something like that, then you don't want to pay extra. You want to pay as little as possible and have the government forgive your loans after 10 years worth of eligible payments. Then you don't want to include maybe your spousal income. Maybe you want to file married separate. But I'm getting too complicated with this now. I'll mention it in a little bit again. So they are pretty much the same thing with a couple of nuances. And because you will all qualify for pay as you earn, I think, you really do not need to worry about revised pay as you earn. The next level up is IBR. It's income-based repayment plan. Now this time, instead of looking at the 10% of discretionary income, they're looking at the 15%. So your amount goes up a little bit, right? So if $53,000 payment is corresponding to, sorry, $53,000 income is corresponding to $300 payment under pay as you earn, with IBR it will correspond to $470 something kind of payment. ICR, hardly any of you utilize this pay. I mean, you're more between pay as you earn and IBR. ICR, I doubt that any of you will utilize this income contingent payment plan. Then now this time they're looking at 20% of discretionary income and the number in the household. Then your payment at $53,000 income may go up to $600, $700 level. Okay, so this is basically what you are going to utilize as health professional graduates, especially in medicine.